When you go onto YouTube and look for undervalued stock videos, you're going to find bunch of videos, but please do not invest your hard-earned money based on those videos, not because those videos are incorrect, mainly because when those videos were created at that time, the undervalued stocks recommended by those videos may be undervalued at that point in time, but may not be undervalued right now. Because please remember, stocks valuation changes on a daily basis. So please, if you do not want to lose your money, do not invest your money based on recommended videos which are older. Is there a better way? Yes, in this video, I'm going to show you a step-by-step process of how to find undervalued stock so that you can do it yourself and invest your hard-earned money the right way. You can like this video so that it stays in your liked video, and better than that, you can subscribe to my YouTube channel so that you have this video as a guiding principle. With that, let's get this video started. The very first thing we will do is to go to Ticker Tape and go to the stock screener. So let me show you how to go there. So click on stock screener here. You are going to see all the listed stocks, more than 4,500. We need to find the undervalued stocks right now from this list of stocks. Please also know that undervalued stock is a stock that is trading at a market price which is lower than the intrinsic value of that stock. Now, the intrinsic value is the fair value of that stock, the actual price of that stock that we should be buying at. And as long as we can find stocks that has less value than their intrinsic value, we are happy to buy those stocks, right? It's very hard to calculate individual stocks' intrinsic value. There are hundreds of theories and models out there. We are not going to use any of that. We are going to use certain ratios and certain symbols and signals that will tell us that most probably a stock's price right now is less than its intrinsic value. And those are the undervalued stock we need to look at investing our hard-earned money. The very first thing now we will do is look at those companies or businesses that have been giving good revenue growth rate in the last 5 years, as well as solid net profit margins. Because if a company is not profitable in last 5 years, what is the point in investing your hard-earned money in that, right? With that, let's just put 4 filters. So I'm going to go into the filters and look for revenue as one of the criteria. We are going to select 5-year historical revenue growth. I also want to look at last 1 year historical revenue growth. It is very, very important because not only last 5 years, I also want to look at how the companies have been performing in the last 1 year, so that if there are any challenges, we are not considering those companies. We are only considering companies which have been consistently in the last 5 years have been performing well from a revenues perspective. Let's add these 2 parameters here. In addition to the revenues, we also need profit margins. Very, very important. Many people only go for sales. But please understand, sales alone doesn't give you the company's value, company's history. So what we are going to do is we are going to select here net profit margin, right? Net profit margin is something that a company is earning after deducting everything in terms of their operating expenses, their taxes, their interest and everything. So we need to look at 5-year average net profit margins as well as last year or the recent financial year's net profit margin. These 4 ratios will tell you exactly how the company is performing, how their business is performing. What are we going to do? We are going to look at certain filters here. So I'm going to say, give me those companies which has got at least 10% annual growth rate in the last 5 years, right? So if you look at 10% here, we are going to get some good companies. It's gone down from 4,500 to roughly 1,600 companies. Likewise, for other 4 ratios, I'm going to select here 1 year historical revenue growth, again 10%. I'm happy if a company has been giving me at least 10% revenue growth in the last 1 year. From a profit margin perspective, again, I'm very happy if a company is giving me at least 10% of net profit margin. It might be more than that. And lastly, last year, they should have done at least 10% minimum as the net profit margin. Based on these 4 parameters, we get 277 companies. And you see the type of companies coming here is all well-known branded companies, which has been performing well in terms of their revenues and their net profit margins. Now, let me ask you this question. If a company is doing really well in terms of sales and profit, is it a good company to invest? Well, not always, because we need to look at their debt position. How much of debt these companies are carrying, so that we know what is the prospects of this company's future performance as well. If a company which has got a lot of debt is potentially likely to fail. Again, I'm not going to pick up any examples. You are very smart to know which companies I'm talking about. So let us go ahead and look at the debt position of these 277 companies and filter out those companies which are performing better from a debt position perspective. So if we just go ahead and put a filter, let us say we are going to get debt to equity ratio. So we are going to consider 2 ratios here, debt to equity as well as long-term debt to equity ratio, right? And I am going to consider out of these 277 companies, those companies which has got low debt to equity ratio and low long-term debt to equity ratio, right? It's not always bad to have debt, because some of the sectors like power, infra, you would need to have debt. The company need to have debt, but as long as the debt is low, equity is higher side, we are happy with that. So we are going to go with low and low here, and we are going to get 176 companies. Look at these companies. They are not having heavy debt when it comes to debt and equity ratio. These are all good companies that we can look at investing. The third very, very important criteria is to look at companies' cash position, because remember, cash is the king. If tomorrow macro conditions go really wrong, can the company survive or not? Do they have the right resources, especially the cash component, to be able to sail through the choppy weathers, right? For that, I'm going to consider two important ratios. So let me show it to you. If you go to add filter again, and we are going to put free cash flow, right? Free cash flow is simply how much of cash the company has after deducting all the expenses and everything. So if we add free cash flow in here, and at the same time, we also need to look at current ratio of the company. If I add current ratio here, current ratio is how much of total current assets the company has, if it needs to pay the current liabilities, whether it will be able to pay it or not, right? So simply we are going to select these two here as well, and you're going to see that I am happy personally. Any company that has got positive free cash flow from zero onwards, I'm happy with that. Also from a current ratio perspective, I'll be happy if a company has more current assets so that it can pay all its current liabilities tomorrow if the situation arises, right? So I'm going to put that as 1, and I'm going to look at how much of companies I'm getting. I'm getting 120 companies. All these 120 companies are profitable. They have less debt component, and also they are cash rich. Look at TCS here, you will see that they are very cash rich. That's why they're doing buyback and things like that. Now these 120 companies are solid companies, but the question is, should we invest our hard-earned money in these companies or not? Well, for that, what we need to look at is the past track record of these companies' capability to give the return on equity. How much of return on equity they have given to their shareholders. If they have been able to give good return on equity, I will consider them, right? For that, I'm going to use another ratio which is called return on equity. So let's go ahead and type it here, return on equity, and you will see that we can use 5-year average return on equity here, and let us just add it here. I am happy to consider those companies that has given me at least 15% return on the equity, because if I'm investing in direct stocks, I need to at least generate more than 15% of return on my equity. Otherwise, I'll simply go ahead and put my money into a mutual fund or index mutual fund, because I can generate easily 12 to 13% there, right? With that, I'm going to select those companies only which has been giving at least 15% of returns. With that, we get to 80 companies. So if we look at these 80 companies, they are profitable, have less debt, cash rich, as well as they have generated more than 15% return on equity. Now we've got a list of solid 80 companies. Does it mean we should put our money in these 80 companies? Well, before we do that, we need to look at whether these companies are overvalued or undervalued. Now comes the most important part of this video. How to know that is by using two ratios. One is PE ratio and the second is PB ratio. Let me quickly add those ratios and find out those companies which are undervalued right now. Because if you look at these companies, TCS, Infosys, Asian Paints, everybody knows that these are good companies. They have been performing really well in the market. But the question is right now, are they overvalued or undervalued, right? For that, we are going to use two filters. One is PE ratio. So I'm going to say PE ratio here, and you will see PE ratio coming here. PE ratio, simply, people who do not know, it is the current market price or share price of that stock divided by how much earning that share is doing actually for the business, right? So if we click on that, add that in here. Also, we would like to add PB ratio, which simply means the current market price of the share divided by the book value of that particular share, right? These are two important ratios that we need to consider. Now, what should be our value? How should we filter out? How do we know which stock is undervalued, which is not undervalued? There are a lot of theories out there. The theory that I am going to pick up is looking at the Nifty 50 as a benchmark. So if I show you Nifty 50 current PE ratio, you will see that the blue line here is how the PE ratio of the Nifty 50, top 50 stocks have been changing in the last 10 years, right? And how orange line you see is how the Nifty has been growing. If you see, you will see that at the time of 2009 financial crisis, Nifty's PE ratio was rock bottom, around 10. And even in 2003 and all, it was 10. It was around 10. If you look at the current Nifty PE ratio, it is trading at 21. If I look at the median PE ratio, it is somewhere around 20 here from a Nifty 50 perspective. What I'm going to do is go at very conservative approach, because I'm already taking a lot of risk by investing in direct individual stocks. I'm going to go for any stocks that are trading at PE ratio which is less than 10, I'm happy. I feel that they're undervalued from an overall market perspective. I'll be happy with that. So that is the logic I'm going to use for PE ratio. But from a PB ratio perspective, if we look at how Nifty is right now doing, if you look at Nifty, at the time of bad times, Nifty PB ratio was down to roughly 2. If you look at the median PB ratio, it is right now 3.51. And if you look at overall conditions, I think we'll be happy to go for those stocks which have got PB ratio right now less than 4. We'll be very happy. So let us go ahead and put those filter criteria back into our screen. So PE ratio is anything that is less than 10. So I'm simply going to say anything that is under 10, I'm happy to take those ones. And from a PB ratio perspective, I'm happy to take those ones which are having PB ratio of less than 4. With that, we get a list of 50 companies that have got all the tick boxes checked for us. These 15 companies are low in debt, high profitability, have given high return on equity, as well as their PE ratio right now is undervalued. Now, before you go ahead and invest your money into any of these 15 companies, please understand 5 very, very important points. Point number 1 is look at all these 15 companies and do a basic research on all 15. Look at their business model and also look out for any red flags. Let me quickly show you one example. So let us say we go for Andhra Paper Limited here. You click on it and you open it in a new window. What you will see here is if you have the pro subscription for the ticker tape, you are going to see these scores here, and you will see that currently the valuation is really good. It is undervalued. Entry point is also good. Current price is less than the intrinsic value that I talked about. Also, there are no red flags on this company. Like that, look at the individual financial balance sheet and the income statement of the company. Look at the revenues, look at the profit margins, and also look at the peers and understand where this company actually stands. From a PE ratio perspective, it is really healthy. Like this, please go ahead and do research on all 50 companies. Very, very easy. It's not going to take you a long time. Point number 2 that I want to make is that if you look at the market capitalization of these companies, you will see that some of these companies are really, really small, less than 400 crore market capitalization. They will be really, really volatile. If you do not want to take that risk, what you can do is further filter out this list. So if you look at the stock universe, you might say that I only want to invest in those companies which are under Nifty 500 universe. You will get top 5 companies that are part of the Nifty 500. That is your second criteria. The third point that I want to make is, let us say now you are ready to invest 5 lakh rupees. Please make sure you can distribute your 5 lakh into multiple of these companies. If you look at, they all belong to different sectors so that your risk is minimized and you go for diversification. Some of these companies are from mining, iron, steel, advertisement, all of that. So your money gets divided into multiple sectors. You de-risk your money. Point number 4 that I want to make is if you're ready to invest 5 lakh rupees right now, please make sure that you do not put all your money in one go. Every month you invest the same amount. For example, you might distribute it in the next 5 months, every month putting 1 lakh rupees in these companies. And point number 5 is please make sure you come back to this screen, run it every quarter and rebalance your portfolio. You will see that some of the companies are no longer undervalued after a quarter because they have been overvalued at the time of that finishing the quarter. You might reap the benefits of selling it out. So you might sell some of these out, buy some more based on your quarterly rebalancing. I hope you thoroughly enjoyed this video. If you did, please press the like button. Let me know in the comments if you like the video or not, because I will continue to make such videos. Keep rocking.